Don Kaufman, and you are watching the TheoTrade evening video, June 9th, 2021. There's 19 minutes to go to the cash close here on this Wednesday afternoon, with the markets once again massively unchanged. Nevertheless, we are highly likely to see some decent volatility inside of this Thursday and Friday's trading session. Let's get down to business and explain precisely why, of course, in this evening's video. As I was saying a moment ago, the S&Ps once again are kind of unchanged here, but I figured I would once again bring out, and if you're looking at this chart with me right now, this is none other than a 30-day 1 hour. Again, a 30-day 1 hour. And you can see the volatility or lack thereof. I mean, we have been in a roughly 20 to 30 point range really since May 20th kind of time frame. But this week of trade, we're inside of a 5 to 10 point range for the majority of trade for, again, Monday, Tuesday, Wednesday. Even more interesting, and again, people don't look at this for what it is worth and some of the edge in here, but what you're looking at down below, this is actually historical volatility. It's the annualized standard deviation of past stock price movement. Yeah, you're down here again, and we are on a 30-day. It is a 1 hour chart. So if you look at historical volatility averaged over 20, it's over like 20 hours, for example, here inside of the S&Ps. And the point that I'm trying to make is right down here. And again, I can't stress this enough. We are literally at 0.02. That's right, 0.02. But at the exact same time, and people look at this like, oh, whatever, man, I get it. There's no movement in the marketplace. Really? Because your VIX right now is actually up quite considerably. The VIX is trading at roughly 18%. Okay? We are looking at, again, the volatility down here at 0.02, which what does that really equate to in percentage terms? Of roughly 2%. But this is actual price movement in the marketplace. This is implied movement. And of course, the VIX is an implication of risk some 30 days out. But how does that compare even in the short duration? Like if you look at S&P futures, and you go to an option chain, you open up, for instance, the next 2 days, and you're still going to see 14% implied volatility versus taking a look at the chart and you've got 2% actual price movement in the marketplace. So for those of you that are in fact selling some options premium, there is definitively edge, and has been throughout the course of this week, because when nothing happens to the marketplace, ultimately that premium simply decays. With that being stated, and again, I wanted to show you some of the historical volatility because quite frankly, this is pretty much the lowest it's ever been in terms of recording for this period of time. So you're looking at a historic moment in terms of lack of movement, if you will, for the marketplace. Push it aside, because get ready to rumble. We're going to see some volatility, and we're going to see some volatility. Obviously, many of you are aware that there is a CPI number coming out, and that CPI number, of course, tomorrow, and if you're unfamiliar with the CPI number, and again, I can actually pop it up over here, the Consumer Price Index, it's inflation. Okay, so there's going to be inflation discussion tomorrow. That comes out at 5:30. Of course, that's Pacific time, 8:30 Eastern time. The CPI number can absolutely rock the marketplace. But I'm going to tell you, really, that is going to be nothing more than a catalyst. Okay, what is really going to drive trade tomorrow? Right, in very large part, that is going to be right here inside of the bond product. So if you are watching the bonds, and I've talked just incessantly about the bonds in the last couple of days, if you watch the bonds, first of all, if you go to the bonds, you have to go adjust for contract changes, hit apply, hit OK. The bonds have, in very large part and definitively, now broken to the upside. So we've actually got the bond market here, which the absolute high of its range is 158. It did effectively kind of break through some of that range inside of the last 2 days of trade, which has, for the most part, cooled off interest rates. This is actually the TNX. This is the 10-year. I cannot stress this enough. One of the key thresholds for the 10-year, is roughly right here. And when I say right here, that would be right at about 1.5%. We're actually under the threshold right now. Okay, so the marketplace at least this point in time is simply screaming, no, there's not going to be inflation. Now, as the interest rates have come down, that has negatively impeded upon the financials. In fact, if you do take a look at the financials and we bring up auto expected moves, we're actually sitting, okay, at the lower edge of the expected move for those financials. All right, so how does this, okay, bring about any degree of volatility? Well, the bond trade, okay, has really bifurcated the marketplace. And to explain a little bit more in detail, as these bonds go higher, of course, interest rates go lower. And this is a dynamic I was explaining a little bit on the weekend update. So as the bonds go higher, okay, tech just loves it. But as the bonds go higher, the financials, they get crushed. So for the most part, you've literally bifurcated the entire marketplace, and the S&Ps are just kind of skirting through the middle. That is what has actually caused, if you will, the lack of volatility. Yeah, that dynamic is about to change. And that dynamic is, again, in large part, going to be sparked by the CPI numbers that come out. Here's one really interesting thing to display to you to give you a feel for what some volatility is going to look like and why the marketplace is likely to, assume a much more volatile stance in the next literally 24 hours of trade. Look at the TLT with me for a moment. And we're actually going to open up option chains inside of the TLT, and I'm going to tighten up the number of strikes in here, because what I want to display to you, it's kind of stuff that people don't often see in terms of the bond markets. Look at, again, this is TLT. This is a 2-day option versus a 9-day option. The 2-day options have 19% implied volatility. The 9-day options have actually dropped to 16% implied volatility. That, okay, that deviation, that differentiation between front and back month vol, that is as much as most financial companies see during an earnings period. What is actually scary about this is not a stock. This is, of course, what? This is the iShares 20-year, right? So there is this huge differentiation between front and back month vol, which is literally screaming that the bonds are about to get downright wicked in terms of that volatility. Okay, this is going to do one of two things. All right, and again, I don't want to lead you to believe that, that catalyst, that we have a good idea where the marketplace is going to head from the catalyst, because you absolutely unequivocally don't, right? What you're going to get, though, is a sharp move in the bonds is either going to rip the financials higher. Okay, here's the key. If the financials rip higher, S&Ps are going to take off to the upside. There's just no question about it. You got to watch the financials. On the flip side of that, okay, if the CPI number comes in maybe a little bit cool, those financials, they're going to come off hard and fast, okay, and that is going to be the nail in the coffin for the S&Ps, and the S&Ps are actually going to get dragged down. Then they're going to turn around and actually take tech along with them. Again, this is a wild kind of dynamic, though, that's going to play out. It's about the bond market, but I'm displaying how it's going to play out in terms of the financials. The financials, this right now, this is the linchpin inside of the marketplace. Listen, the financials, they are what got the S&Ps to this current level. Take a look at the financials on a year-to-date basis in a general, percentage. A year-to-date, they're up about 30%. Compare that to the QQQ, which is only up about 8-9%. You kind of get it, right? Tech is not nearly as important as you think it is. Financials are going to set the tone. However, it's the order flow that's going to pile into the bonds that's really going to set the financials. You can see coming into today's close here, 10 minutes to go, the S&Ps are only off 7. Okay, the Nasdaq is, as I said, massively unchanged. But why? Why are we actually seeing, for instance, okay, the volatility futures, their bid? The VIX, its bid. Okay, take a look at the VVIX. It's flying right now. We're back up to the 120. Everybody sees it. You got to be prepared for some price action tomorrow. Last, but definitely not least, I'm going to leave you with this. The SPX. This week, we were actually sitting looking for a $53 move. Again, a $53 move is what the expected move was for the week. So that is $53 higher or $53 lower. Where are we right now? As we said, we're unchanged in the week. Price action should very much lead us to the upper edge or lower edge of this expected move. This is unequivocally, people, listen, it's a binary event. Again, we wish we could tell you more about direction of the marketplace. I may carry some bearish positions, and I'm an individual that just loves volatility, but there is no feel to this. It's going to be predicated exclusively on the order flow that comes in the morning. Thanks, everybody, for joining us here at TheoTrade. Have a wonderful evening. Bye-bye.